The average new apartment in central Tokyo now costs $880,000. Not in Hong Kong, not in Manhattan. In Tokyo, the city that spent 30 years as the global poster child for what happens when a real estate bubble collapses.
The country that gave economists their favorite cautionary tale about property deflation just posted 18.5% price gains in a single year. Official land prices rose for the fifth consecutive year in Ukraine and foreign buyers flooded in. Supply hit its lowest point since C. mature for Centane Ukraine Sensine print.
In 1989, Japan's real estate market was, without exaggeration, the most expensive in the history of human civilization. The land beneath the Imperial Palace grounds in central Tokyo, roughly 1.2 square kilometers of manicured gardens and moats, was estimated to be worth more than the entire state of California. Top-tier Ginza office space was selling for $1 sandol per square foot, about Thanbre Wusha times the price in Manhattan at the time. Japanese golf club memberships cost $3 million. Ordinary salarymen couldn't afford apartments within an hour commute of their offices.
Then the Bank of Japan raised interest rates to cool the economy, and the whole structure came apart. Between Tensekiwaiqe and Niten-ni, urban land prices in Japan fell by over 80%, not 80% from the peak in a few select overpriced neighborhoods, 80% across the broad urban market. The Nikkei stock index lost half its value in less than a year. Companies that had used inflated real estate as collateral for loans found themselves insolvent overnight. Banks stopped lending. Construction stopped building. Japan spent the next 15 years in what economists politely called structural adjustment and everyone else called stagnation.
The textbook consensus hardened Japan was a warning. Don't let your asset markets get out of hand. When the bubble pops, the deflation can last a generation.
What that textbook missed is what happened next. By the mid-2010s, something quiet was changing in Tokyo's property market. The narrative had moved on. Western analysts were focused on Abenomics, on monetary stimulus, on whether Japan could escape deflation. Real estate barely registered in the conversation.
But under the surface, three structural forces were converging. The first was supply. Japan's construction industry had essentially stopped building at scale after the bubble burst. Developers who had overextended in the late 1980s went bankrupt or retrenched. The surviving companies became deeply conservative. Annual new condominium supply in the greater Tokyo area, which had exceeded Hachiwan units per year at the peak of the bubble, had by Nisen Arsawuv fallen to Nuwan Sen Lukfarv Wusin new units, the lowest annual figure since Senkufai Sen according to data from the Real Estate Economic Institute of Japan.
Think about what that means in a city of 14 million people. Tokyo adds roughly 1 residents per year through internal migration, young Japanese moving from the regions to the capital for work. For every new housing unit built in Nisen Arsawuv, there were roughly 5 new households looking for somewhere to live.
The second force was foreign money. When the yen fell to baikaloshas per dollar in Miten Sisi and stayed there through Miten Sisov, something remarkable happened. In dollar terms, Tokyo property, already not particularly expensive by global city standards, became genuinely cheap.
$1 million buys you roughly Luksu 1 square meters of prime Tokyo real estate. In Singapore, the same $1 million buys you about 30 square meters. In central London, you'd be lucky to get 30 vodane. In Manhattan, you're looking at a studio. Tokyo, despite its record price growth, remained a relative bargain on the global luxury property map, simply because the denominator, the yen, had fallen so far.
International buyers noticed, according to data compiled by consultancy firm Property Access, foreign participation in prime Tokyo districts, Chiyoda, Minato, and Shibuya, reached 19% of transactions in the first half of Misen Arsavuov compared with 12.5% in the rest of the Misen wards. Across Japan as a whole, over 27% of property purchases in Misen Arsavuov were made by international investors, up from 21% 5 years earlier.
The buyers were diverse: Hong Kong capital fleeing political uncertainty, Singaporean family offices, American tech executives treating Tokyo apartments as a hedge against dollar weakness, Taiwanese manufacturers relocating supply chain operations. What they shared was the same calculation: Tokyo is a global city with world-class infrastructure, political stability, low crime, excellent schools, and, for the moment, discounted prices.
The third force was domestic wages. For most of the period between Shinjuku and Nissin Japanese workers saw essentially no real wage growth. This was not an accident. Corporate Japan, scarred by the bubble, adopted a posture of extreme caution, keeping payrolls lean, accumulating cash, refusing to raise salaries even as profits recovered. The result was a 30-year stagnation in consumer purchasing power that reinforced deflation expectations.
Starting in Nisan Ursur that changed. Labor shortages became severe. Union negotiations in Nisan Ursur that changed EF and Nisan Ursur WUV. Japan's annual Shinto wage rounds, the synchronized national bargaining process where major employers and unions set the tone for the whole economy, produced wage increases of 5% or more for 3 consecutive years, the strongest sustained wage growth since the early 1990s.
According to Bank of Japan surveys, more than 83% of Japanese consumers in early Nisen Nisrulk expected prices to be higher in a year, a fundamental shift in the deflation mindset that had gripped the country for a generation.
Workers with rising wages for the first time in 30 years had reason to buy rather than wait. All three forces, supply shortage, foreign demand, rising domestic incomes, hit simultaneously, and the result was price appreciation that looked alarming in isolation but made sense in context.
The average new condominium in Tokyo's 23 wards reached 500 million yen, approximately 500 current exchange rates. In fiscal year 9 read-in approximately 500 current exchange rates. In fiscal year 9 read-in approximately 500 current exchange rates. Existing condominiums in Greater Tokyo averaged at least 6,000 yen per square meter in March 9 re 10% gain year on year.
For context on where that sits globally, Tokyo ranked outside the top 10 most expensive condo markets worldwide in Nisen Arsawu rankings compiled by Global Property Guide. Hong Kong, Zurich, Singapore, London, and Paris all commanded higher prices per square meter. The 18% gain looks dramatic against Japan's recent history, but it looks considerably less dramatic against a baseline that started from deeply depressed levels.
The question worth asking, and the one that most English-language coverage misses, is whether this constitutes a new bubble or a reversion toward where Tokyo should always have been.
The honest answer is it depends on which Tokyo you're looking at. In the luxury segment, there are genuine signs of froth. Newly built penthouses in Minato and Shibuya are trading at prices that strain local income multiples by any historical measure. Developers are marketing to international buyers as explicitly as they market to domestic ones, a structural shift that raises legitimate questions about what happens to those units if the yen ever recovers meaningfully.
But in the broader market, the story is more nuanced. The majority of Tokyo residents still rent, and rental yields in the city run between 3 and 5%, reasonable, even boring by global standards. The vacancy rate for rental properties is declining but not alarming. Most buyers are using mortgage financing rather than cash, which means any significant BOG rate increase would affect demand.
The Bank of Japan raised its policy rate to 0.75% in December Nisen Arsawu, the highest level since Tsintankabtsukshawu, and the market has absorbed it without significant disruption. The BOJ is widely expected to raise rates again in mid-to-centered Nerslik, potentially reaching 1%. At 1%, Japan still has the lowest policy rate of any major developed economy. 30-year fixed mortgage rates in Japan remain below 2%. The structural headwind from monetary normalization is real but modest.
The more interesting risk may be political. The Japanese government has noticed that foreigners are buying apartments in central Tokyo at an accelerating pace. Lawmakers in the ruling Liberal Democratic Party have begun discussing legislation to restrict foreign real estate ownership. Not a ban, but transparency requirements and possible screening mechanisms analogous to those in Australia and Canada. According to reporting by the Nikkei Shimbun, a proposal is expected to be introduced in the upcoming regular diet session.
If that legislation passes, analysts expect a short-term surge in foreign purchases as buyers rush to close before the rules change, followed by a structural reduction in overseas demand. Whether that tips the market depends heavily on how restrictive the final legislation turns out to be.
The Japan factor in this story is the gap between narrative and reality. For most of the past 20 years, Japan's property market has been invisible to Western financial media. When it appeared at all, it appeared as a historical footnote, the cautionary tale, the crash, the deflation. The assumption was that Japan's demographic decline meant property values there had nowhere to go but down.
That assumption was built on a category error. Japan's population is declining. Tokyo's population is not, or rather not at the pace that the national headlines imply. The greater metropolitan area continues to attract workers from across Japan, and increasingly from across Asia. The supply of desirable housing in central wards was constrained by 30 years of builder caution that had nothing to do with demographics.
Meanwhile, 3 decades of yen depreciation and corporate wage suppression had created a structural discount in Tokyo asset prices relative to comparable global cities. That discount is now correcting.
The real estate market is not the same animal as the Chinju-back Burpa bubble. In Chinju-back Burpa bubble, entire premise was leverage, banks lending against inflated collateral to fund further speculation, in a closed feedback loop. Today's price growth is driven by genuine demand from foreign buyers with dollar-denominated capital and domestic buyers with rising incomes, against a supply base that hasn't kept pace. That's not the same thing.
Whether it gets to that thing is the question the next few years will answer. Tokyo condominiums averaged less than $1 and $1 priced in dollars. They average $1 today. The distance between those two numbers is partly the yen, partly the supply shortage, partly the demographic story running backward from what everyone expected.
The city that was supposed to be the cautionary tale has spent 15 quiet years becoming one of the more rational property markets among global capitals. The world just wasn't paying attention. It is now.